Hi, everyone. And once again, an official welcome from my side to the Pro Investor Business Plan Live Series, Part 3. Today, we're going to start what I call retirement planning. We're going to talk about financial planning, just conceptually speaking. This we need to cover before we really go into the nitty-gritty rules that you can see all of those rules later on. Towards the end, we're going to talk about my investing rules, right? And we're going to talk about all the rules that come into play with that. But before, similar to milestone planning, we need to talk about retirement planning conceptually and what our goal is, what our expectation is in the market, and how we're planning to achieve that. And before we do that, we have to finish off, of course, the money management topic as well, where we left off last time. So that is what we're going to start, and we're going to spend just a couple of minutes here. Last time I got the question from one of you guys as we talked about winning and losing streaks and the cycle of each trader, and your cycle potentially being contra to that. We talked about this last time, and I got the question towards the end. It read similar to, Jan, what does a winning streak look like? So we did a little bit of work, and we just looked at all the trades since October. I already shared this in the last DMO. I shared my trades. And so within the last DMO, I shared my trades. And so these are from October, right? And so you can see there's crude oil, right? My markets, gold, silver, platinum, Nikkei, Russell, Dow Jones, the usual markets that I cover. You can see whether it was a winner or a loser. And you can also see the R's that we collected, the conservative R's, right? I always took the conservative R's of what I basically also told you guys what I was going to do. You know, whenever we trailed, I told, you know, I also took the ones, and whenever we had a 1 to 4, we took the 1 to 4s and so on. Also, the recent losses are here. So my personal winning streak at the moment since October is, based on the sessions that we had, is a 70-30 win to loss ratio, collecting a total of 39 Rs in 5 months time. That is just me, right? And Toby also looked at his trades, right? These are Toby's markets. Toby had also quite a solid risk win to loss ratio, where every second trade was a winner. He collected a total of 35 Rs in his session, and burned as well, what we talked about last time during the DMO, his markets, orange juice, live cattle, and majors. He has a 54 to 46% win loss, and he collected a total of 27 Rs. Now, if you put all of that together, you have a total of 101 Rs with a 60-40 win to loss ratio, 30 total of winners with an average risk to reward of 1 to 4, which is far exceeding all the objective goals that we have. So clearly all put together, it's a winning streak. So now you may say, well, you know, some of these trades here, Jan, you know, I'm not over leveraging here. I'm only just taking one here. So, you know, we could reduce some numbers here, take some away, or you could say, well, I missed some of those trades as you were maybe, you know, cherry picking or doing whatever you were doing. And so what we then could say is, for example, well, there's a margin of error because you're a beginning, so 50% margin of error. So you would only take half of what we, as 3 mentors together, collected. You would still end up with 50 Rs in 5 months, which would be 10 Rs per month. 50 Rs is the Rs that you need to collect as a 2-year goal, right? And so far exceeding the expectations, the goals that we put in place. And therefore, this is what a winning streak looks like, right? And it's fascinating for me also to see, because obviously I had it on the radar that my trades were going quite well. I was on a winning streak. I'm also not expecting you to take every single trade, because I'm also not taking the trades that Toby's taking. I'm also not taking all the trades that Bernd is taking, right? And they're also not taking some of the trades that I'm taking, and vice versa. But we all did collect ours during that time, right? And individually, we're all kind of on a winning streak, which is kind of amazing to see, because that means that it's not the trader itself that is usually on the winning streak, it's the market that provides. And sometimes the strategy just works beautifully, and at times it just doesn't, right? And obviously there's then other things that play a role here too. But with all of that, right, with all of that, you guys have plenty of content, plenty of content to go in and practice and assess your trades based on copying our trades, right? And so that's just as a little bit of a side note. You can also go in and, you know, go into the DMOs and take a look at the kind of trades that we took and how we took them. Most importantly, why I'm seeding this now is later on, once we talk about logging, it's not just about, you know, logging the trades, what was a winner, what was a loser, and how many hours did we collect, and tracking the KPIs. That is easy. What we need to do is we need to assess these trades too. We need to evaluate them to understand what really works and what may have not worked, right? Did we do everything correctly? Maybe we did some mistakes. Maybe we need to change our strategy slightly. We need to adapt it to the current market environment. Whatever needs to be done, our trade log is going to spit that out for us. And how we're going to approach that assessing, right? Assessing of goals, assessing of KPIs is very important, because we want to pursue goals. We want to assess them. That's very important, because without assessing them, we will potentially not reach the goals that we want to reach. Right? This we need to make progress at the end of the day. So without going too much into this, I just wanted to seed this. I'm not expecting anyone to have 100 hours. I do know that some of you have already collected a lot of hours, to an extent where the hours from the end of last year covered your hour performance from last year, and at the beginning of the year already covered your yearly hour objective. I know that some of you reached that. Obviously 100 is a stretch, because I also have not collected 100 hours. So it wouldn't be fair to say that you should, right? What I'm saying is we are as a whole at the moment on a winning streak. And if you have been with us for quite some time and you do not know what a winning streak looks like, then you potentially fit straight into that cycle where now you're becoming more active because you see things are going well, what we discussed about last time, right? Where that psychologically fits in. And so you can identify that for yourselves as well. And most importantly, what that also means is that regardless of what you do, what kind of trades you take, you have to follow your own cycle eventually, right? You can follow our cycles if you follow that consistently, but eventually this also shows, regardless of the markets that you cover, the strategy works, right? You do it on the agricultures and on the majors, overall, it works. You do it on my markets, overall, it works. You do it on Toby's markets, on super random stocks, right? And minus, and it works. And that's just beautiful to see conceptually as well. And so without, you know, covering this much more, because I don't want to lose much more time on this, I just wanted to cover this because I had the question last time, what does a winning streak look like? And I couldn't answer it with numbers. So now we have the numbers that back this stuff up. Obviously a losing streak then looks a lot worse, right? And then a losing streak may look like 5, 6, 7 losers in a row. It's all possible. I've had that before, right? And I think anyone who has been in the market for more than a year or 2 years knows that it's possible to have a bad losing streak as well. We need the winning streaks to cover our losing streaks. as we are basically moving from one extreme of the bell curve to the other extreme of the bell curve. But let's cover money management and finish that off here as well. Last time we ended the topic on over leveraged risk settings, and we said that when we have the following trade setups, which include fundamentals as well as technical alignment, then we're allowed to over leverage in the trade with a 2 to 3x of our normal risk size. And so some examples are equity indices in October and November, and precious metals in December, January. Both are buy points. Those will not work every time, and those trades in general will not work every time, but they're the most consistent trades that I personally have and that I have seen work for many people most consistently. So these are the ones we can over leverage on. There are also times, however, where we may see some things setting up all together, but we do not want to over leverage. We want to take that as one trade. So there are risk limitations. We do that to avoid large drawdowns. So for example, when we see equity indices setting up and we don't have the fundamentals aligned with that, or if we see precious metals setting up and we don't have the fundamentals aligned with that, we may have some alignment, but not the perfect all stars aligned picture, which is also maybe sounding vague to you. We'll cover that once we go into the rules, my trading rules topics. In that case, you want to divide your desired risk size into those assets, into those markets. So for example, if you're trading equity indices, S&P 500, Dow Jones, and Nasdaq, 3 of them, if you have the perfect picture, if you have the perfect fundamental and higher time frame alignment, then you can trade one risk size each, right, consistently. If you don't, then you trade a risk size 1 and you divide that 1 into those 3 markets, or you pick 2, or you just pick 1. I always like picking kind of at least 2 because you protect yourself from taking the one that's underperforming the others, right? Which oftentimes is the case, especially as we approach precious metals. One year we think silver is going to be stronger than gold, and then the opposite is true. The other year we think gold is going to be stronger than silver, and then the opposite is true again, right? I think this year we did a pretty good job in understanding that palladium is going to be the strongest, platinum the second strongest, and then gold and silver will follow. When we took the second round of gold and silver, we said, well, let's only do gold with reversal and let's trade silver first, because silver looked a lot stronger than gold. What actually ended up happening is the complete opposite. Gold was a lot stronger and did a lot more hours than our silver trade, where we collected 2 hours and gold went into the ultimate target of monthly supply, where we had achieved the 1 to 6. And so we want to do both in that case. And that's also why we traded both. And then we divide the risk size in however we do. If we have 4 setting up and we want to trade all 4, and we can over leverage 3x, then we divide 3x into 4, however that may look like. You can do 1 for palladium, 1 for platinum, and you divide 1 between gold and silver. So a half and a half for silver. If we had risk limitations, right, because we didn't have the fundamental picture, then what we would do is we would divide 1 potentially into 4. And so it would be 0.25, 0.25, 0.25, 0.25. We do this because we understand that these markets are highly correlated, positively correlated, and that if one fails, they will all potentially fail. Just like what happened now with our equity index long idea from the February low, where we got stopped out now, where all of them 3 were setting up and all of them 3 were stopped out, right? And so if we over leverage that trade, which I did, then you have a 3x loss. But on other times in October, when you over leverage this, you take them 3 altogether, you make a 1 to 4 on average, for example, that is times 3. So you make it 12x. So 12x minus 3x, still a 9x, still gives you headway in the market. The thing is, we need to do that consistently, and we need to have a way on determining when to do it and when not to do it. So when to do it is very important here, and we'll talk about this perfect setup, this alignment that we want to see later on once we speak about my trading rules, right? My trading rules, which will be a very, very large chapter where we cover everything in detail, and you can see this best fundamental setups here. And these are going to be the times where we can then go ahead and over leverage. As we may be over leveraging and we may have a losing streak, there's also a possibility that we experience large drawdowns. So if we experience large drawdowns, of course, what we have to do is we have to make sense of why this has occurred, right? And of course, as a rule that you can put down is that you will only put additional funds to your account once you can, well, first of all, additional funds that you can afford to lose, and you will only then commence trading if you have identified the cause of the drawdown and you have retested, right? This may come with mistakes, with mental mistakes, with overconfidence, with fear, with FOMO, whatever the reason is. This may also be the case, and just following the rules has also happened to me before. Just following the rules and losing streak and large drawdown. This is the time to sit back, relax, reevaluate, and only after some time, after you've gained some confidence back again, you approach the markets again, potentially scaling down your business, right? And then you go back in and attack the markets again. What about chasing price, right? As we talk about all of this, well, chasing price is something that probably all of us have done in our, lifetimes of traders before. Is if we miss an entry and we see price rallying or dropping without us, and we jump the gun and we jump into the market, that should only ever be allowed within our price action and signature set of rules. What we need to understand that opportunities in the market, they come and go, right? And this is not the end of the world. Life goes on, even if you miss one trade. You can see this, that even if you miss 1-2 trades, life will go on. The beauty about these trades, they are cyclical, they are reoccurring, they're coming every year. Some of them aren't, right? Some of them aren't. But the bread and butter kind of trades, most of them are reoccurring every year. So what we have to do is, rather than dwell on them and saying, well, I missed this trade now, is we need to ask ourselves, why did we miss this trade? Why did I miss this trade? And you want to put in place protocols to not repeat the same mistake, right? And if that continues to happen to you, if you are a well-seasoned trader and you have a lot of trading experience and this stuff still happens to you, that you miss trades, then what you really want to do is you want to work on your trading routine and put in place a solid calendar where that will allow you to always stay on top of all of the trades that we do. We're going to finish this topic with some golden rules on risk management that I want everyone to have written down. Number 1, until I'm a well-seasoned trader, I stay at milestone 1 or 2 and only trade with very little risk or using a demo account, right? And so that goes in line with the milestone planning, where I do want you to move up the rank rather quickly, but you can only move up the rank rather quickly if you become a well-seasoned trader and if you're doing well, right? Otherwise you won't. Number 2, until I'm a well-seasoned trader, I will not trade more than my maximum risk size and do not over leverage my trades. So in the beginning, as you are in the $200 milestone 1 or $400 milestone 2 range, you may not want to over leverage, right? Because you're still working on your experience. You can potentially over leverage, mentally, but I always first recommend to 1 year see how the over leverage trades work, and then repeat the same thing the next year once you're in milestone 3. Anyways, as you're in the first 2 milestones, it's not so much about making money. Yes, the yearly profit is great and all of that, but what we want to focus on is achieving that consistency in the market and really gaining confidence in the market, internal as well as external confidence in the strategy and internal confidence in yourself. And once you've achieved that, you can then move to the next milestone. And then when you're over leveraging, the over leveraging will become, harder. But at that point, you have already had a lot of experience and seen how that works, right? While in the beginning, if your first few trades are already over leveraged trades, it's not something that I will ever recommend to you guys, because you first need to see how you personally react to certain trades, certain environments, to a certain amount of losers in a row, to a certain amount of winners in a row. Learn it about yourself, and then once you are well seasoned, you can start over leveraging. Number 3, very important here. I will not risk big to win big. This idea has been invented by casinos to make money. The way how we will win big is to be consistent over time. The emphasis here is consistent over time. The only way how I can be consistent over time is to play this game, to be in this game all the time, right? I cannot be 2 months in, 2 months off, 1 month in, 1 month off. Doesn't work. I need to be consistent over time. And we want to play this game with even a small advantage, and then we can become a large winner over time. Again, over time. And what the casinos have been telling all of us is to risk big to win big, while what they are doing is to have a small advantage in their favor, and over time they become large winners, which is exactly the same what we're trying to do. So we cannot never risk big to win big. Number 4, as my level of skill, experience, and account balance grows, I will look to scale up my business. If I consistently lose, I will reduce my risk size or move to a demo account. Nothing that I need to add here. Number 5, I will not compare myself with others. We have a social trading platform. We have a news feed, and we have so many different levels of skills and level of experiences in the room, and where the hours per month and the average risk to reward and the average win to loss ratios are as wide as it can get. So we should never get into a habit of comparing yourself with others, even not comparing yourselves with us. And that's why I also said, if we have 101 hours at the end of 5 months, that's not what I'm expecting from any one of you. 50% margin of error rate, even that probably I wouldn't be expecting of any of you. Some of you do have that. Some of you may even have more. But with all of that, what I would expect is you achieving your R targets in those months, right? That's what I would expect. And so let's not compare ourselves with others. Let's focus on our games, because some of us have been trading for almost a decade and you have not. And so the sane approach is starting out with a minimum exposure to monetary risk. Number 6, and we'll finish off with that. I need to embrace losers. Yes, we want to lose. We do want to lose. We really do want to, even though that's completely counterintuitive. But we now know that the only way our brains can become more plastic is if we have losers, because losers allow us to assess our strategy, right? And so in assessing our strategy, we can then adapt, customize, and enhance our strategies along the way. Because eventually what you want to end up with is your trading cycle that fits not my cycle, that your trading strategies shouldn't fit mine, because my level of experience, my level of skill is very different to yours. And also my trading character may be very different to yours. In fact, Toby, Bernd, and mine trading character are completely different. And so you need to find a strategy that fits all of that along the way and tweak it along the way as well. Again, how we can achieve that, we'll do that within the logging sessions. One last topic on milestone planning. With all of that, right? With all of that, what we want to do is we want to put in place protocols after each and every milestone that we achieved, right? So after completion of each milestone, I write down what I have done extremely well and what I've done poorly based on the trading log critical questions section. I will list my learnings and protocols below. So for example, what this may look like within the milestone 1 is when things go well, I tend to overtrade after I close a trade. And then the protocol would be that you put in place is after I close a trade or many trades that go well in a row, I will wait a day to reevaluate the market objectively, assess new buying or selling opportunities, and only enter a new trade if all conservative rules are met. Also, for example, after losing streak, I tend to take small profits. I see this over and over and over again. We've had a losing streak. Then we have a couple of winners, and those winners, we take small profits, which is natural for us because we want to recoup our losses, but it doesn't make sense in terms of the KPI game that we're trying to achieve, right? And so we need to overcome that thought of recouping losses quickly. We will recoup those losses over time, but we will never recoup losses by taking small profits. So then what we can do, for example, is you can put in place some rules that, for example, state, well, I needed to hold on to those trades for longer. I will try to stick to my planned targets without trailing too early. And you will put in trailing rules based on my trading rules later on that will fit your log and your level of skill. Now, money management and milestone planning, two very important topics that I think, especially money management, is the kingdom to wealth. And this every one of you should really understand conceptually and the basics on, right? And before I move on to financial planning, which is the counterpart to milestone planning for trading, financial planning for investing, I just want to ask if everyone is on the same page, if you're following, if I'm going too fast, and let me know. If you have questions, also feel free to let me know now before I move on. Colin is asking, I see that Toby has also trades with 0 Rs. Is there any rule to apply to anticipate a 0 trade? At least one does not lose money, right? A 0 R trade would be a break-even trade. I've also had break-even trades, but I didn't list them here because a break-even trade will not flow into the win-loss nor the risk-reward calculation, right? And so with that, I just didn't include them. Toby made the work to include them for him, for his trades. I think Bernd did maybe as well. Yes, Bernd did as well. He also included the break-even trades, while I didn't. And so, yes, of course, there'll be break-even trades. And in an ideal world, you want to log those, right? If that was the question. Sivar is asking, is there a way to keep tracking as a live document that we all can access? I do want to say, yes, that is a possibility, but we're not going to do that. And we're not going to do that because that will take away from what you should be doing yourself, right? And if we do the work for you, very likely you will not do it. The only ones that I have known, the only traders that I have known to become eventually good traders, consistent traders, are the ones that had solid logs, that really were able to see black on white how they met their KPIs and assess their trades and everything that comes with that. So yes, of course that's possible, but I don't think we're going to do that because you need to put in the work. Otherwise, it's not going to work. Right, Sivar? Does that make sense? What we can, of course, do is quarterly updates to see, look, this is how we're doing. These were our trades. Some of them were losses, some of them were wins. But anyways, if you're following our DMOs, you know that anyways, right? So there's nothing I need to tell you how well I'm doing or how badly I'm doing, because you have constant constant access to that, and you see that instantly in the marketplace. To Colin's question, he's referring that to trailing. Yes, that will be trades where we trailed, that were going directionally right at first, and we put our stop loss to break even, and then we got stopped out as price moved against our trades, which trailing is a topic by itself that we need to cover within the My Trading rules later on. All right, CVAR motivational, right? Very good. We can maybe do something like quarterly. We'll see how it goes. But I think once we show you the logging file that you can easily use to log yourself, you anyways don't need us doing that anymore. Cool. So all clear so far. So let's go with retirement planning. Retirement planning is the counterpart to milestone planning. Milestone planning is we talk about trading, right? And when we talk about milestone planning, we talk about what milestone do I need to reach to achieve a certain income monthly or yearly, and to be eventually on a level of, I call it FU, and to quit your job and be what we call a full-time trader. While this may be a very good goal that I think will get a lot of you going in the beginning to really start as a motivational factor to start trading game and all of that, I think the real goal that we should all achieve, that you should all achieve, is not being a full-time trader. Because, and I'll tell you why, the real goal that you should be following eventually is early retirement. And early retirement is a combination of financial planning, retirement planning, and milestone planning. The best way how you can achieve early retirement is with a combination of those two. Become a well-seasoned trader, understand the markets and the skill of timing the market, and understand the fundamental drivers of the market, but also become a long-term player in the market. You guys are most of you guys are in very comfortable spots because you all have consistent cash flow. If you ever move to a place where you're trading full time, you're only relying on trading, you do not have a consistent cash flow anymore. And so the mental game in terms of trading will completely turn on its head. It will not turn on its head if you have a very solid base in terms of retirement planning. And while you have a consistent cash flow in terms of a corporate job, it's very easy to make progress in the market as we follow the market, right? And so long-term wealth and retirement can only be achieved by time in the market, being exposed in the market over time. I need to deploy my capital into stocks, cryptocurrencies, or any other assets for longer term growth, it can be real estate as well, to make use of the natural updrift of asset prices. This is based on that notion that over time things get better, and as things get better, asset prices will rise in value, whatever those asset prices are. Now, the idea of this strategy, well, of the strategies that we have here, is really not to potentially make money every single year. In fact, my entire goal here is not to make money at all. What I'm focusing on is I'm focusing on strategies that will allow all of us to outperform the markets in the long run. And as we outperform the markets, we will make money over time. What that may look like, we can look at this later on, but we have a couple of strategies that we use to do that. If you have never heard of any of those strategies, then what you need to do is you need to go into the stocks course and watch the stocks lessons within the classroom section. So we have a strategy called the Campus Equity Index. The Campus Equity Index, in short, is buying the 5 lowest priced, relatively low PE stocks within the Dow. Later on within my investing rules, you will see this completely explained, what we're doing and when we're doing, right? But just conceptually speaking, here, this is a strategy that we follow. And you can also see the market commitment is going to be 40% roughly of my idle cash for this strategy. Now, 40%, don't quote me on this. Don't use that as a benchmark. Whatever you want to do here, you have to evaluate that yourself as you understand all those strategies. And then you come up with what you think is the most reliable and the best performing for you over time, right? Obviously, there will be performance reviews as well that you have to do. And so with that, over time, you may shift, that may change. But I think the 40% here is a very good starting point. Why is it a good starting point? Because the Campus Equity Index, I call it the strategy for the corporate executive, the busy person, the lawyers, the heart surgeons, the executives that have family, that juggle everything, you know, and that have very little time. So it's the dentist strategy, if you will. Why is it the dentist strategy? Because it's the only objective strategy that I know of that achieves consistent and comfortable gains year over year over year. Not just gains, but as you backtest this, even manages to outperform the equity indices, even the ones like S&P 500 or Dow Jones. And so if you look, for example, at the S&P 500, where in the last 30 years, you may have achieved a 10% average growth year on year, and that is taking the bad years into account. With this strategy, which is also very objective, the same every year, you don't use any time for this. You know when to do this, you know how to do this, you just deploy capital. You actually outperform the index by 2x. So instead of making 10%, you make 20% every year. It's the only strategy that's mechanic and objective that I know of that can do that. And so I looked at all sorts of different ways on how to evaluate different stocks objectively. And I did the computerized back testing on this, where every year it was the same, where one year I only, you know, would focus on some certain evaluations of stocks. And in fact, the lowest price, lowest PE stocks every year would perform overall, as you take the average, the best. And 20% with the bad years. And then if we can only, if we can also sidestep the bad years, the recessions, fundamentally, then we can make crazy headway in the market. And that is going to be, that has to be our plan. And that's why there should be the most percentage here. It's also the least volatile that I know. And after all, if you're now saying, well, you know, how do I know that this is also going to work in the future? And also in the future, we are going to be able to outperform the market. The reality is, I don't know, right? And nobody can guarantee you that. I cannot guarantee you that this strategy is going to make money, and I cannot guarantee you that we will outperform the indices. That is just what the data suggests in the last 30 to 50 years, okay? Now, my assumption is that the markets will not change, right? And so that has to be your assumption as well, because the only way how we can create wealth and retirement in the long run, retire early, is to be in this market early and to follow this market. Make use of time in the market, what that means to our accounts, we'll look at later. The belief that that things will get better, and with that, we can make benefit of the natural updrift of asset prices. And so this strategy has a very little focus on timing. The only way how we time this is we look at the yearly roadmaps, which we also share within the stocks sessions. Once a year, we have a yearly roadmap, right? And then we look at the good buy points, which one is now, February and now, and the other one is in October. And then we deploy our capital into those 5 stocks, and then we're done. Now, this is the entry strategy, right? We need an exit strategy. We may want to have an averaging in strategy. And so Sibor had a lot of questions on the newsfeed talking about some of the trades that he's not in and how an averaging in strategy then would look like. We can talk about this later as well, but we need to talk about this in detail when we talk about my investing rules. Just conceptually speaking, when we buy and when we want to deploy our idle cash, I am personally not the biggest fan of averaging in, because when I do this and I do all my homework, I believe that market will go up, right? That's just my belief. If I don't believe that, I will not buy. And so averaging in is a strategy for someone who will not time the market, who will most likely also buy at the top. We will never do that, right? We will never anyways buy something at the top of the top of the top. That's not ever going to happen. Also not with the comparative strength index. And so if you ask me even, then you can do as much as you want here. You can go as high as you want here in terms of your exposure to the Campus Equity Index, because it's just such a powerful strategy. And you'll see that between 10 and 20% in the long run per annum is anyways all you'll need. Now, I also know that every one of you in this room loves the market, loves looking at the market. And even though you may be lawyers and dentists and corporate executives, high grade executives that are very busy and have family commitments as well, you still are looking at the market and you love the market and you want to analyze the market and you want to go and branch out on other strategies. And I'm the same, and that's why we came up with the Campus Comparative Strength Buy and Hold strategy, where we're analyzing the market based on the same seasonal buy points, but we're going to look at the markets that are comparatively the strongest in the game. Not at the moment, so we won't buy at the high, but the ones that have also experienced heat. And so we'll look at the Campus Buy signal, at our valuation tools, and we will wait for monthly demand within uptrends. And so as we take those players, those usually are the most volatile players in the game, our market commitment should be less in the beginning, because even though we are timing the market within and close to monthly demand, we can still take heat. Example, Facebook, example, PayPal, right? But we will not just buy 1 or 2 stocks. We have to buy at least 5. And the more we have, the better, because the more diversified we are within this specific strategy. So I like to have at least 5. Otherwise, I will not deploy. And so you need to plan this out before you deploy, you need to plan out what you'll deploy and when you'll deploy, and then deploy it all. And then what's your averaging in strategy is also something that you want to put in. Again, I'm not the biggest fan of an averaging in strategy, because if I buy those, I believe they're going up sooner or later, right? And so, for example, if you look at our comparative strength stocks at the moment that we've just recently opened, AMD, Disney, Facebook, Netflix, PayPal, Amazon, and now Starbucks as well, then you'll see that some of those we are taking a beating, and some of those are gainers. And as you may now have an averaging in strategy, you may say, well, on all of them, I'm just deploying 50% and I wait the other 50%. Well, on PayPal and Facebook, you now be able to buy more with the other 50%. But what about the rest? You're buying higher, right? You're buying higher. So usually, as we use anyways our ways of timing the market, we don't have to average in. We want to deploy our capital because we believe that the price will go up, right? We believe in our timing tools and that overall the price will go up. And so even if you now average in, your average overall may be just similar to what it would have been if you just bought at those prices. And what you want to do is you don't just want to pick two and then buy them, right? And do cherry picking. For example, you may have just said, oh, I like Facebook because that's just my bias, and I like PayPal because I believe in this. You just pick two and you may be picking the losers. So you want to pick at least 5. And so in the beginning, we picked Amazon, PayPal, Netflix, Facebook, Disney. Actually, PayPal and Facebook we didn't pick. We picked Amazon, Netflix, Disney, and AMD, which is only 4, right? Close to 5, knowing that Facebook and PayPal would come down lower as well. And now we triggered those as those were come lower, and the others, right, that have not yet been triggered, that cash is still idle. So it's also not deployed. And so if let's say we plan 5 or 6 and only 4 are triggered, then I'm not dividing my deployed capital into 4. I'm dividing it into 6 and I'm only deploying the 4. And so 2 of that equal weight will still be undeployed, and it will still be idle, just sitting on the sidelines, waiting for JP Morgan Chase and Walmart prices to come a little lower so we can take action, just like on Starbucks. So we can take action. And actually I revised this a little bit because the next day when I posted, price opened on 87. So this was the next entry date that you guys could have achieved on the next day. And you just want to buy it, right? Because you are close to monthly demand and all the rules are aligned. And so you just want to buy it. Few dollars up, few dollars down. It really doesn't matter at the end of the day because we're making use of time in the market. Sewar is asking, how long do you plan to be in these trades? Forever, right? You want to be, time in the market means you want to be in those trades until those trades or the market will tell you to get out, right? And so the exit strategy is what we would then be talking about. The exit strategy also will have to be put in writing within our investing. When we talk about my investing rules, we talk about the exit plan. Basically, the only time we will exit those trades is when we fundamentally see something shifting in the market, some warning signs, which we'll talk about at a much later date. The beauty about Campus Comparative Strength, as well as while the Campus Equity Index, it's every year the same in terms of the strategy that you use, and the companies will be kind of similar. It's objective. You use the same thing every year. The Campus Comparative Strength, every year you use the same rules, but every year there'll be different stocks, right? And so this is why this may not be as objective and mechanic as the Campus Equity Index, because every year it may be a different list. And so it's very difficult. It requires a high level of skill to do that. And so that's why you can see 40% idle cash versus 20% idle cash. Eventually, as you do your performance reviews, you may say, my comparative strength stocks have done so outrageously well, I will switch that. And then if the data shows that, you can also do that. Now, Cullen is saying, when investing in these companies, does it mean that all the other rules, supply and demand, direction, momentum, should be applied, or simply buying the companies at market? And so, Cullen, for that question, obviously you don't have all the backdrop information in terms of the rules that are applied within that strategy. Obviously, there's a lot of rules that come with why did we pick those companies. And so, yes, we look at supply and demand, direction, and indicators as well. And so we want to pick the ones that are comparatively the strongest. There's a way on how we can analyze that technically and fundamentally. And so the set of rules will become more clearer as you watch the stocks course and as we talk about my investing rules later on. The strategies here are very different in how they set up. The Campus Equity Index is defense, right? We're looking at really what stocks have the most value. We're looking to be very mechanic and play defense and make consistent gains. What we're trying to do with that is we're trying to, within a specific pool of stocks, we're trying to avoid the losers and pick value defensively. The Campus comparative strength is offense. We're not trying to avoid we're anyways trying to avoid the losers, but what we're trying to do is we're trying to pick the winners of tomorrow, which is extremely difficult to do that consistently. So it comes with market experience and set of skill. And that's also why the percentages here should be different in the beginning, but you should definitely potentially do both. Because I know we all love stocks and we all want to go outside of that very boring Campus Equity Index, even though that does extremely well. Seymour, are we still in the Campus Equity Index from last year? Of course you would be if you had deployed that last year. And so last year, October, then the October prior to that, right? If you had deployed that, you still in this. And so this goes back from last year, October, where we have a roughly -2% at the moment, not making money, but outperforming the equity indices, also on the way down with -5% on the Dow Jones, assuming the same entry dates, right? On the same date, we enter all of them, outperforming the Nasdaq by massive numbers on the way down. And so we're defensively picking value on the way up, as well as on the way down. We will outperform the market. Well, we potentially will outperform the market, right? I cannot guarantee you that, but what I want to do is give you the best tools to potentially achieve that. Yes, so Seymour is saying very important. He's saying not November last year, October last year, the year before that, we keep those trades year on year on year. So October 2020, October 2020, October 2021, yes. October 2020, potentially, what we want to do is want to look at the fundamentals as well, right? So the entry strategy. Within the entry strategies, there need to be a set of rules. But from last year, October, where we talked about this, and the year before that, you would still be in, and you would do rollover on those stocks and taking out ones that have moved up the rank and putting in ones that have moved in the rank and shifting your money that way and doing rollover basically. But we will stay exposed in the market for as long as we see fundamental warning sign popping up. Why is that the case? Time in the market. Why is that the case? Well, that's the case because all of us, we can be wrong in our timing, right? And our timing can be off and we can miss the boat. We can be in the boat too early. When it comes to longer term stocks, as we anyways use a way of timing them, I'd rather just be a little too early than too late, right? And so using those set of rules that we have will allow you to be not too early, but also not too late, and potentially have a little bit of a middle ground here, where even if things go bad, you will still outperform the equity indices, which is our main goal. Does that make sense? So you're just trying to understand, we'll keep these trades open till 2025, or we will exit in July 2022, or wait to buy again in November, right? CWAR, yes. So you will stay in those trades, right? The money that you deploy for retirement planning is not money that you need to have access to 2 months down the road. It needs to be idle cash that can be deployed into those strategies, that can be deployed in here for years. It's the only way how we can make use of this natural updrift. But how exactly we can achieve that, and the set of rules that we have to do then the rollover and to find new stocks that fit in here. Basically, rollover then means find new stocks that move in our list and remove some stocks that may be heated or very expensive at the moment, and move and take them out, and then kind of rebalance our portfolio. And there will be ways on how we do that, but we will keep that money in that account. And why do we keep that money in our accounts is basically a very simple calculation that I'm sure most of you did, that I don't even want to talk about too long. But for example, CWAR and everyone else, if you took $100,000 and you're applying a 10% growth per annum, which is not Campus Equity Index, which is not Campus Comparative Strength, which is just the market itself, which is the S&P 500 or the Dow Jones, just going with the market without doing any other strategy. The average is 10%. So a 10% growth year on year, year on year, year on year, at year 10, you will have doubled your capital. In year 20, you will have more than $500,000. And in year 26, you will have more than $1 million to retire, starting with $100,000, right? But this only works if this money consistently stays in this market. It has to stay to make use of the market as a whole going higher year after year after year. Now, I'm also not saying, just like with milestone planning, right? This is not science. This is not 10% or 20% every year. This is maybe 1 year a loss. Maybe if we can't even maybe if we manage not to sidestep a recession, then it may be a large drawdown in a year. But as we leave the money in, we potentially can make up for that. And 1 year we may have a -10 here. The next year we may have a +20. Right? Or a +30 or a +50, who knows, right? And then 1 year may be a break-even year. But the average is then what's going to count year on year on year. And that accumulation of your capital as you leave that money, as it's sitting in your account. And then you may say, and I know this because I've thought this way 10 years ago, close to a decade. Well, not quite 10 years ago, but close to a decade, when I first approached the market. I was so into trading and milestone planning that I totally forgot, and I did not see the big picture. What you can achieve in 10 years. What can you achieve in 5 years? Not what can you achieve after 10 trades. And of course, mentally and psychologically, in terms of neuroscience, it's a lot easier to focus on near-term targets. And it's very difficult for us to focus on long-term targets. It's very, very hard. And I wish that someone had told me when I started to just start with following the market, with some of these strategies that we're introducing. Because if I think about, if I had started 10 years ago instead of 4 years ago, this is a crazy number that you will see in terms of difference. And so you just need to start regardless of capital. why am I introducing ways on potentially outperform the market and not just saying, well, go with the market as a whole, is because I know that not all of us have $100,000, right? And so if we have $10,000, you do the same calculation. Instead of 10% per annum, you make 20% per annum. Guess what? You just need 1 year longer to reach the same goal. Isn't that crazy? So if we can just double that, which we can with the Campus Equity Index, which we could have, right? Historically speaking, backtesting, then we only need to deploy 10,000 year after year after year after year, let that sit in the market, not even redeploying new capital. And in just 1 year more, we make the same amount. That's how powerful the growth, if we can leverage on the growth, that's how powerful this can become. And if you are completely crazy, let's all go crazy, then we could even take the strategy and leverage it by 1.5. Right? And so then instead of making 20%, you make 30% a year on average. And then you may say, well, who's going to tell me that this is going to work? Well, you know, after all, if you're deploying a strategy where you're buying real estate, if you're deploying a strategy where you're buying the S&P 500, you're always basing this on the study of the past, and you're predicting the future based on the study of the past. This is the only way how we can become successful. What is a good trader? They make future predictions based on the study of the past. So we are lucky enough to have the study of the past, right? We've done the back testing, and we have seen that the Campus Equity Index outperforms the S&P 500 by 2x, 20%, taking the bad years if we can sidestep the bad years even better. And so I can really just urge everyone to look at retirement planning in any form, in one form or another, whether that's Campus Equity Index, Campus Comparative Strength, other stock picks as well, all right? Like some of the stock picks that we also put in our financial planning sector, where you have stocks like Median Gains, Clinuvel, Volition, Santhera, or even your own choice, like Alibaba or NIO or whatever that company may be, that you're then also deploying some cash on, but the market commitment on those should be a lot less than kind of the safe bets, because other stock picks are not safe bets, and they may take very long to actually come into fruition, to make headway. And then once they come into play, they make crazy headway. And we want to make consistent and slow headway year after year, rather than sitting on a lot and then at one point it just all goes crazy. So that's why here you may have a little less than on these strategies. And then of course, a cryptocurrency portfolio can go up to 30% here as well. I will not go too much into the strategies that you can deploy that. And the main reason for that is because I do not have anything to back that up, right? I do not have a record to say, well, I'm really a guru. let's talk at a professional, let's say a professional in the cryptocurrency market space, right? But we do have some questions that we ask, for example, when we look at cryptocurrencies, which later on within the My Investing Rules we can talk about. But I think when it comes to your crypto portfolio, everyone has to decide this on their own. I also understand that it is very unlikely to have anyone in the room without having exposure to crypto, and probably also we shouldn't, right? All of us probably should have some exposure to crypto. There's also ways on how we can time that with monthly demand and with what Bernd is teasing all the time, the cycle analysis that we were planning to launch soon. And so there are ways on how this can be achieved as well with market timing. And so this can be part of your capital as well. Now you may be saying 30 plus 10 plus 20 plus 40, that's 100%. I don't want to invest 100% of all my idle cash. That's not what I'm saying. What I'm saying is whatever you want to invest, this should be the this could be the way how you split that money within that overall retirement planning portfolio. But it could also look very different, where you say 100%, I'm just going to follow Campus Equity Index, or you're going to say, I'm going to do 50% here, 50% here, or you're going to say, I'm going to focus more on cryptocurrency and have a high exposure here, right? There's no right or wrong here, right? And who am I to tell you what you should be doing for your retirement? I can, of course, show you the strategies and give you the information about those strategies, but then at the end of the day, every one of us in the room has to decide that on themselves. What is the expectations for this? Well, long-term investing comes with great risks, right? The future is unknown and it is hard to predict. However, to achieve long-term wealth, we must have our capital deployed at almost all times. And so long-term investing, buy and hold strategies benefit most from time in the market as opposed to timing the market. Guess what? We do both, right? We do both. Every time we deploy, especially on the Campus Comparative Strength, we time the market. We buy the market not at the top. We buy it when it's 40% down, right? When blood is on the street with our Campus buy signal, that would be signaling that, or within monthly demand, within uptrending markets, that would signal that, or the lows are holding. And so we are buying always into weakness. And so while we're making use of time in the market, we are timing the market as well. And even with timing the market, we understand that we can take heat at certain times, right? Imagine with timing the market and using the best rules that I know of, using monthly demand, using indicators, buying when prices are 40% down, and we're still maybe taking heat. Imagine that somebody may be taking heat on without timing, market timing. So we always have to compare apples to apples. What would it be like without any strategy, right? And these are just the best strategies that I personally know of, and so we have to follow them consistently. And so I just wish someone had told me all of that 10 years ago when I started. So we all should have a focus sooner or later on that. And of course, we need to have a performance review on all of this. And performance review on 1 year may not be sufficient because it's these are long-term strategies, right? And for example, other stock picks, they may take longer to really come into fruition. However, eventually, depending on what your growth rates were year on year, you may choose to focus on what works best for you. It's not mandatory, but this then at that point can be argued. So we can only do this after, I think, at least waiting a full year, if not even longer. So Clemens is asking, Jan, given the target of 24 hours per year and you are consistently profitable, would your money not be better invested by putting to work by increasing your risk size rather than in the retirement portfolio? Or is the retirement portfolio a hedge against your active trading? That is a very helpful and very good question, Clemens. At the end of the day, there's no right or wrong. With milestone planning and with the trades that we're taking, everyone takes a different approach here in terms of how many trades one takes a month, how many trades one takes a year. And based on that, their risk per trade and their milestone plan is going to be built on. Now, if you move up the rank and you are starting to risk a higher amount of money, I can promise you that you are probably going to start to trade less, right? And as you start to trade less, for example, let's say you are at milestone 7, you're trading $5,000 a trade. As you start to trade less, the maximum requirement for us to go into that trade based on our risk parameter, which then at this point may be 10% if you're well seasoned 20, if that's not all your wealth in the world, right? It can be 20. You only need $25,000 to $50,000, $25,000 to $50,000 in your account to go into a trade here, right? And so if you have more, all of that cash would be sitting idle on the sidelines, not being deployed in the market. And the entire idea of combining trading as well as investing is to maximize the use of our capital. How can we put our capital to work the most efficiently and maximize that? Well, we use leverage for a reason. We use leverage to maximize the use of our capital so that we don't need all of our money in our accounts to go into a trade, right? Because we get 100-to-1 leverage, we get 50-to-1 leverage, all of that good stuff. I only need 20%. I only need to have an account size of $25,000 to $50,000 to go in a trade worth $5,000 of risk size. So I'm very flexible with everything else that I have. So let's say you have $500,000 in your account, then you do not just want to live on trading, right? You want to make use of, let's call it the easy money, growing with the market, and you want to put that money to work as well in a way that year on year on year on year on year is going to be amazing growth in terms of also the yearly profit that you will make, right? And so the higher the amount of money that you have, as a rule of thumb, the more money you have, the more your focus is on long-term investing. The less money you have, the more your focus will be on milestone planning in the beginning, because this is how you can make, with very little money, more headway in the market space, right? And at the end of the day, we need to be good traders, good market timers, understand the fundamentals, all of that knowledge that we have, to be good retirement planners as well eventually. So for me, it's a combination. I don't think one is more powerful than the other. I think it depends on everyone's characteristics and what they want to achieve and their capital at hand. And no right or wrong. So always a combination of the two. Does that make sense, Clemens? Good. So one is truly monthly income, quarterly income, paychecks. You pay your costs with that. You make a living off of that, right? You pay whatever you have to pay. It's a salary, but everything that's on top, everything that's left behind, we make use of that, right? And we make use of that in the long run. Maximize the use of our capital. All right, so roughly over, I think, an hour and 10 minutes we've been speaking today, and I think I also covered the key aspects here of retirement planning. Do you guys have any questions on all of this? Very, very good question, Clemens. I love it. It's good stuff. All clear so far? Yes, most of the questions will come as we work on the document. Yes, you are. The beginning few slides, everything that we've talked, you can see it's kind of building up on something, right? It's building. Everything that we're talking about has been so far very vague. It's kind of conceptually, right? We have not talked about what is the also very important piece of this document, piece of this puzzle is, yes, of course, this is the plan, right? This is the plan, but what are we going to do to achieve this plan? What are the ways on achieving my milestones? What are the ways on achieving the 10 or 20% on average per year? And this is where my trading rules, and you can see it's just page after page after page, followed by my investing rules, page after page after page, will come into play, that we will spend the next sessions on, really going into detail on all of the rules that you should have as part of your trading strategy. And as we talk about those very, very slowly, we will then always come back to the information that we talked about before. So we have done a lot of seeding, right? The reaping will come with the set of rules, right? Why are we doing what we're doing? Because that's the plan, that's what we want to achieve, right? And so that's planned for next Sunday. So without much further ado, I'd like to thank you all for joining and participating. I'm sure we're going to, you guys will see me tomorrow doing a DMO as the market opens. And so I'll catch you all tomorrow. Until then, good night. Thanks everyone once again. And I'll see you all tomorrow.